precious metals for more than just inflation. Featuring Monex and the world-renowned commodities research firm, the CPM Group, led by Jeffrey M. Christian.
Hello, this is Sean Brazney, Sales Director with Monex Deposit Company. I'm here today with Jeffrey Christian, Managing Partner and Founder of CPM Group, one of the many analysts they have there at CPM Group. But again, privileged to have you with us today, Jeffrey.
It's good to be with you guys.
Yeah, you're coming out of a conference up there, I know, so I know you've been sharing all kinds of data. We're looking forward to getting some of that out of you as well. And one thing I want to really touch base with is U.S. debt. It seems to be growing so fast that it's hard to really keep your finger on how big that number is. But I'd like to address, how big has the U.S. debt gotten? And also, one of the questions we get when we ask callers as to why you're interested in buying precious metals, we get a common answer back in that they're thinking that the debt's gone too far. We're not going to be able to service that debt. If we start to raise interest rates, we're going to raise them so far that we'll bankrupt the company and crash the country, and crash the dollar. And that there's no way to service it, and rates can only go so far. And I thought it would be a great opportunity to really get some good data from you on how do we really service that debt.
It's a real issue, and it's a real problem. Right now we have, as of the end of May, $30.4 trillion in federal debt. People will talk about the unfunded long-term liabilities of the government, and they'll add that to it. But that's kind of a straw man that fearmongers throw up, because they never look at the long-term assets and income that the government is projected to have too, which is a big offset. But looking at the snapshot of the fiscal balance of the U.S. government right now gives you enough reasons to be very anxious. $30.4 trillion in debt. And yes, that's up from less than $20 trillion 6 years ago. And it's less, when I like to tell the anecdote that Ronald Reagan ran in 1980 saying that the U.S. budget deficit of $58 billion under Jimmy Carter and the U.S. debt, which was approaching $1 trillion, were unsustainable. And he was wrong, because 40 years later, we have $30 trillion worth of debt and like a $1.3 trillion deficit. Now, these possibly are unsustainable, and there's a great deal of very valid reasons to have a lot of anxiety about the fiscal balance in the government. But you shouldn't be fearful of it. And the good news is that we could get out of this. The bad news is that we would need political will, as we had in the 40s, 50s, 60s, and even into the 70s, that we just have not seen in this country, either with our political leadership or our people, since at least the 1970s, to solve it. It's a solvable deal. And one of the things to realize is that you've got $30.4 trillion worth of debt to pay off. You don't necessarily have to pay it all off to turn the tide of expectations. And I'll tell you what I mean. In the 1993, 1994, we probably had about $14 trillion worth of debt by that time. So over 14 years, we've gone from $1 trillion to about $14 trillion. Don't hold me to the $14 trillion, but it was about that. And when Bill Clinton came in, he ran on a platform of saying, I'm going to cut taxes. And his financial advisor, Bob Rubin, my old boss, said, you can't afford to do that. You have to pay attention to your deficits and your debt so that the next time we get into a recession, You won the recession because you won the election in 92 because of the recession in 91. You have to get our fiscal house in order so that the next time we have a recession, the government has the capacity to deal with it financially. So Clinton raised taxes and he started charging fees for all sorts of things that the US government used to give away for free. And he actually turned a $325 billion annual deficit and growing debt into about a $250 billion surplus for 4 years and paid down about $1 trillion of debt. So at the end of his administration, we still had 13, 14, 15 trillion dollars worth of debt. But we had shown the world that we had the political capacity and the actuarial expertise to figure out how much we could raise taxes and charge fees for everything from entering national parks to build services for people's yachts, and start paying this down. And the dollar rose very sharply during that period of time because people saw that the US economy has this tremendous capacity to generate wealth. And if the government is sensitive as to how it does it, it could pay down its debt. So we're sitting here now with twice as much debt, $30 trillion, and we need to do something with it. And ever since the 1980s, Fed chairman after Fed chairman has gone to the Congress twice a year for the Humphrey Hawkins talks and says, the Fed deals with monetary policy. We can stanch the financial bleeding during a recession, but we cannot, and we can sort of try to control the demand side by raising interest rates or sucking money out of the economy by not selling, by not buying bonds. But we have very little control over the supply side of the real economy, and we have no control over fiscal policy. And since Paul Volcker in the early 1980s, Fed chairman after Fed chairman has gone to the Congress and said, you have to get your fiscal house in order. And instead of getting it in order, it's gotten worse and worse and worse. And that is a problem. Now, if the Fed were to raise interest rates really sharply, there's a fear that it could bankrupt the government. The reality is that it probably wouldn't bankrupt the government for several reasons. First off, the Fed, whose major client is the US government, would not bankrupt its client. It wants that client to go, and it's very sensitive to it. Second thing is that it can raise interest rates a long way before it got that bad. And the third thing is that the Fed is the buyer of last resorts for US Treasuries and is perhaps the largest buyer and holder of US Treasuries right now. So as such, it has a vested interest in making sure that the US Treasury doesn't go bankrupt. And it also has the capacity to continue to finance deficits and growing debt. So there's a lot of reasons to be anxious, but the fear that is pervasive in some parts of the gold and silver markets is ill-founded on a lack of understanding of the way fiscal and monetary policies have been operating really for the last 40 years.
Yeah, great data. When it comes to economic growth and looking out into the future, I am hearing a lot, not only out there online, but as well as with investors and callers that are calling in. Stagflation is starting to come into the conversation quite a bit. That we may be headed for not the kind of growth that we hope for or need. Do you see a lot of risk for that moving forward?
I'm hearing the same thing that you're hearing. And again, it goes to that whole issue. You should be anxious. If you're not anxious, you're not paying attention to what's going on around you. But you shouldn't be fearful. And there are a lot of pundits in the mainstream media that really don't understand what they're talking about. And there are a lot of fearmongers who are trying to sell gold and silver based on this idea that the world's going to collapse, the dollar is going to collapse, the treasury is going to collapse. And there's a wide spectrum of economic and financial activities between where we are today and such a catastrophic issue. If you look at just recently, Jamie Dimon said there's a hurricane coming. And I'm not sure if it's a run-of-the-mill hurricane or a Superstorm Sandy, but people should be preparing for it. Now, I have friends in Florida, and when we were younger and a hurricane was coming, they would have a beach party with beer and steamed shrimp. They've survived dozens of hurricanes. It's not the end of the world. But the next day, you start seeing some people talking about, oh, Jamie Dimon says the economy is going to collapse. No, he was talking about a storm coming, like the ones that we saw in 2020 and 2007 to 2009 and 2001 and 1999 and 1987 and 1980. He was talking about a recessionary condition and potential financial market problems that could be severe, depending on how everything shakes out. He wasn't talking about the collapse of the system. And that's the right approach to it. And you should be looking at your assets. It's very funny because people are asking me what they should do today. And I tell them you should be reducing your debt. You should be buying gold and silver. You should be building up cash reserves. And you should look at your stock and bond investments and get rid of the weaker portions of it. And then I say, this is the same advice we were giving our clients in 2005, 2006, in advance of 2008 and 2009 and 2010 and 2011. That's what you should be doing.
Great segue for me right here, Jeffrey, with another reason to call Monex and get the most recent report by CPM, Precious Metals for More Than Just Inflation. You can get details like we've talked about today and much more. Extremely valuable info. Thank you for your time today, Jeffrey.